So a lot of people like come to me and go, Gary, I don't want to buy that property because it's negative cash flow. Sure, but like there aren't very many positive cash flow in Vancouver, Greater Vancouver. And so a lot of it is mostly asset appreciation play. And so I actually talk to a lot of clients and they're talking about like, oh, it's all about cash flow. Because I went to some real estate investment seminar and they're all talking about cash flow. It's great if you live in a city that's positive cash flow everywhere. But if you're living in a city like New York or Tokyo or like London or like Vancouver, positive cash flow is quite rare. And so asset appreciation is the play. And for a lot of people, like, they talk to me, oh, Gary, like, then what do we do? I go, like, let's talk about where you're at financially. And so if they're at kind of an entry level, they don't have a lot of capital, then maybe asset appreciation is more important because they don't have a lot of money to play with. Right? And so I actually liken that to in stocks. That I hear a lot of people, like, I'm not very professional in stocks, but then I hear people go, oh yeah, just aim for the dividend stocks, only dividend stocks. Right? But then I realized that, like, if you have only a couple $100s to play with, or like only a couple $1,000, that dividend is very minimal and it's not going to really affect your life at all. Like maybe like $50 a month or like something like that. So can you give your feedback on that?
Well, again, it just goes back to the numbers, right? Like if you invest into a bank and it pays you 4-5% dividend a year, right? So your $1,000 will only give you $50 a year.
Divided by 12 is $4 a month.
Right. So then again, is that enough to pay for your interest? Right. So again, just the cash flow is very important, right? Again, you gotta understand that if your outgoing cash flow is $1,000 a month, then what's my incoming cash flow gonna look like? Whether it's your job, whether it's your investment property or stocks, you just gotta make sure whatever's coming in is enough to pay for that piece.
Yeah, that's important. So like we get into this conversation, me and my clients, about cash flow is king or like asset appreciation is king. And then I've been in this industry for like over a decade and like I've heard it all. Like not all, but I've heard a lot of like, oh, it's all about cash flow and then all about asset appreciation and oh, I want best of both worlds. Okay, I get it. But I realized that it's when you talk to the client and see where they're at, and depends on what their goals. If they're like, oh, cash flow, like sure, but I try to educate them based on like, okay, think about it this way. Like if you just aim for cash flow, but your wealth grows at this speed. But if you aim for asset appreciation and you make a bigger pie, when your pie is bigger, it's much easier to generate. Like even if you generate a lower cash flow percentage, the money you get is much bigger. So like a 10% cash flow, 10% return on $100 is $10. 1% return on $1 million is, $10,000.
Yeah.
So which one would you rather have, right? So I always tell my clients like, okay, well, see what level you're at and see you like my thinking, like it's changed over the years. Before I was like, I went to those real estate investment seminars and I got programmed to think, oh, it's all about cash flow. All about cash flow. Even if it's $10, $20, whatever.
Yeah.
But later I started seeing like a lot of the super wealthy, they care about cash flow, but they also they care about asset appreciation. But because their pool of money is so much bigger, so that even if they get 1 or 2% return, their 1 or 2% is significantly larger than my 30% on $100.
It comes down to what stage of life you're in, right? Like if you're in growth mode, as you and I are, based on our age, cash flow, like I'll use property as an example. Does our property really need to generate cash flow when we have our job to generate the cash flow, right? Whereas someone who's retired or going to retire, they want their assets to generate an income because they won't have that ability to generate income anymore, right? So I think it really just comes down to what stage of life you're in.
So like I tell my clients like, I tell some of them like, hey, you know what? Negative cash flow. Don't focus on the positive cash flow. Focus on negative cash flow, but massive asset appreciation, right? Usually it works that way. Negative cash flow, asset. I give them the example like, hey man, nobody buys Apple expecting dividends. Or nobody buys like Tesla expecting dividends, right? When you buy high quality, generally it's high asset appreciation. When you buy low quality, generally it's higher cash flow relative to the price. And so I explain it to them that way. And I guess like when you have a big enough pie, like it's so much easier to generate wealth. But when you have a small piece of pie, even if you got 100% return, but like 100% of $1 is only $1.
Oh, 100%.
Right? That's like, do you get that do you get that pushback from your clients sometimes? They're wanting the cash flow, but you're like, hey, well, maybe let's grow the pot a little bit bigger.
It's a little bit different on my end because we have so much different tools we have access with. So they don't necessarily would push back and say, hey, I don't want to do this. It's more like educating them, hey, based on your current situation, what you really need, right? So again, for younger people like ourselves, we don't need the cash flow. Let's just aim for the capital gains, right? Whereas someone who's retired or going to be retired, they don't have the ability to work anymore. So they need more cash flow than for the capital appreciation. So my philosophy has always been, okay, now, younger, you want to grow that nest egg as big as you want, as big as you can.
Yeah.
You know, when it gets to $1 million or $2 million or $3 million,
much easier to get cash flow at that time.
Exactly, right? So if you imagine this, if you didn't use this time to grow your nest egg, right? So let's just use easy math. I have one person's $10 million nest egg, one has $1 million. When they both retire and then just generate 5% in cash flow, well, the person with the $10 million is going to get what, 500,000. The person with $1 million is only going to get 50,000. You see the difference, right? So you want to use this time to grow that nest egg while we're young, get the capital appreciation, grow as big as we can, and then flip the switch and use an income strategy to generate the income when they retire.
So like that's a really great point because, you know, in the real estate investing seminars, they talk about, oh yeah, just only buy properties that have positive cash flow. But if you only have limited income or limited like money to play with, you want that asset appreciation so you have more money, and then when you have a lot more money, then you can buy more properties. And that's where, yeah, cash flow is great when you have 100 properties, but if you don't even have like 1 or 2, right? Like how are you gonna build to 100 properties if you don't have the cash? And so yeah, there's like multiple strategies, how like refinance, blah, blah, blah. But for most people, like if you can use asset appreciation and like buy a property, house or condo or whatever, negative cash flow, but after a couple years, it's appreciated a couple $100,000 and you sell it and then you use that money to like build your cash reserves, and then you can buy more than one property later. And so it's much faster to grow your wealth that way. Because most people make, you know, $50,000 to $100,000 a year. Like, so for something to appreciate a couple $100,000, that's like 10 years of their work, right? We like back before I was in real estate, you know, I was making like $40,000 a year, and I was talking to colleagues and they were like making $40,000 a year, and they go like, oh yeah, so-and-so made like $300,000 on this buy and flip or whatever. We're like, $300,000 a year, that's like 10 years of work, right? And so it blew our minds. So now that I'm in real estate and I see that, I can understand why asset appreciation does trump cash flow in many cases, especially for those starting out. But because I don't know if it's society or real estate investment seminars, you know, they're all pushing cash flow as king, and yeah, depending on the person, depending on which stage they're at.
It also comes out, don't forget tax. Right? We haven't even talked about tax yet, right? So, you know, simplest terms is that rental income 100% is taxable, whereas capital appreciation is only half of your gains are taxable.
That's right.
So we incorporate tax into your calculation. It makes more sense to get the capital appreciation versus an rental income. Right? I mean, you know, there's a whole deductions and everything that we can talk about. But if I'm just saying, hey, if between capital appreciation and rental income, which is more tax advantageous, capital appreciation is the way to go, right?
Yeah, I totally agree with that. So like slowly, like I've been in the industry and I've seen the different philosophies, and I bought into it. Like, oh, it's all about cash flow, because I was exposed to Robert Kiyosaki and Rich Dad Poor Dad, and they talk about cash flow, right? It also depends which area you're born in and which area you're investing and all that stuff. But anyways, I bought into that, and then as I worked in real estate, I was like, how come the wealthy are not investing in cash flow? They're investing in asset appreciation. I was like, that's like yeah, there are some wealthy investing in cash flow, but those often had like 50 to 100 properties. But how did they get the capital to invest in the 50 properties to begin with, right? So later I started to see why the wealthy were investing in like asset appreciation. And so like it's really important to like not get affected by the fads out there, like the trends and what you so-and-so made X amount through cash flow and that thing. It's very important to talk to a professional, and definitely want to talk to a team of people, right? You want to work with like a dedicated realtor, a dedicated investment advisor like Joe, like, you know, a tax specialist, maybe a tax accountant, etc., right?